your webcam is on at the top, the button. You can see the turn off.
So I was setting up. There you go.
Okay. All right, we are live, guys.
All right, perfect. All right, hey everyone, welcome to Market Insights Virtual Summit that's happening today and obviously yesterday on the 9th and the 10th of January. Obviously, this event is proudly organized by MarketWise Asia. We're very excited to have all of you coming over from the previous session organized and hosted by Boris. We've got a lot of good feedback from that session, and I think that we're going to have the same for this upcoming session. So before we get started with the session, I do have a couple of announcements and some good information that you guys should know. So first of all, I would like to take this time to thank some of our sponsors, Pepperstone, obviously, and SG Securities, also known as StockGen, and also Tokenized Exchange. We also have a couple of media partners that we would love to thank. Second of all, I would encourage everyone to join our Facebook and Telegram channel, so you would be able to see some of the important updates with events, with market information, any interesting news. They will all be shared on these platforms. I'll get Alex to send across the link to join the Telegram channel as well as the Facebook page. By the way, Alex, say hi to everyone.
Hello, Alex here from MarketWise Asia. I'll be your co-host for today as well, and you should see me in the later part of the afternoon more. All right?
That's right. If you were here yesterday, you would have seen Alex and I basically killing it, obviously, throughout the day. And Alex obviously is the one that knows best about all of the marketing material, all of the promotions, all of the event partner discounts that is available this 2 days. Okay, so if you have any questions, please feel free to drop Alex a message. Okay, next thing is we have a little bit of a surprise or a goodie bag for you in that as long as you share the event via Facebook, Twitter, or LinkedIn, you will be able to stand a chance to walk away with $50 eCapital vouchers or a $50 NTUC Fair Price voucher. We do have 8 of them to give away, so I highly encourage you to share the event. You can click on the link that Alex just sent in the chat to share that event on Facebook. All right, so that's something else that I do want to let you guys know. And next, we also have what's coming up in the next event. Obviously, we're talking about the first quarter. We do have our upcoming event on the 27th and the 28th of March, where we will be talking about the second quarter of 2021 and its outlook. Now, during that summit, we have a very special guest, and he is none other than Rainer Teo. He will be delivering a keynote session on that day, and he is actually one of the #1 most followed trader in Singapore. So if you're interested to find out more about the event and the registration, do click that link that's available on the chat box that Alex just sent. And if not, that's all of the announcements that I have, other than one last thing to make sure you guys are aware of is if you have any connection issues. First of all, for the best experience for this stream, do watch this on your laptop using the Chrome web browser, and make sure that you have a stable Wi-Fi connection. And I would encourage you to plug in your earphones so that you get the best audio quality. Next, if you do experience any connection issues throughout the stream, don't panic. There is a red color reconnect button at the top of the screen, and once you click on that, it should work. In the case that it doesn't work, then I would suggest that you close the browser and reopen a new browser and enter that link in the address to rejoin the room. And that's all the information. If you're still experiencing any technical issues, then you can feel free to drop Alex or myself a message. Now, with all of those house announcements done, we can now move on to our highly anticipated session by none other than our very handsome Chris Weston. Chris, could you say hi to everyone?
Hello, how are you going? Hopefully you can hear me okay. Can I just confirm that all sounds okay?
Yes, perfect for us over here.
It's good. Perfect. It's good. All is good. So, Chris, this session, a lot of our viewers have been looking forward to this session. Chris obviously hosts over 19 years of experience in financial markets, both in London and Melbourne, and is a highly respected financial services expert. He's done positions at Merrill Lynch, Credit Suisse, Morgan Stanley, and IG in both research and sales and trading roles across retail and institutional clients. Now, if he's not qualified, I don't know anyone else that would be. Okay. He also has extensive and enriched knowledge of FX, equities, trading, and risk management strategies. The list goes on. It is a very impressive CV, so I'll leave it at that. And Chris, I'll pass the time over to you. You can take over the stage.
Well, I'm going to share my screen now. Hopefully this this all looks good. Does that look okay?
Yes.
Perfect.
Good.
Okay, so yeah, that was a really flattering introduction. So thank you for that. My role at Pepperstone is really putting out research to clients. I put a lot of focus on upcoming events, you know, the expected moves in markets, which is something that we'll talk about quite in depth today. And really looking at the probabilities about those different outcomes, whether you can use that in your risk assessment to understand whether you hold positions over those announcements, and you know, really putting quite a lot of consideration not just into themes that are going through market, but also how you protect yourself, whether you want to be involved in the markets, and the sort of expected movement that we're going to get through in the markets, which can be really useful for not just for position traders, scalpers, you know, all different types of traders, whether you're a discretionary trader or whether you're a systematic trader as well. And right at the epicenter of financial markets, in my opinion, as part of that risk strategy is volatility. Volatility is the most important factor in my trading process that I use. And just before I go on, I just want to sort of give a quick disclaimer that everything I say today is general in nature. It is not a sort of consideration of my employer. It's everything of my own thoughts. These are my own views and should not be contained as personal advices. If there's any advice, it's general advice only. So I'll just keep that out. Okay, so we're going to go into. I'm not going to go into in depth into my own process that I've sort of honed over the 19 years of my trading. But with volatility at the epicenter, I want to try to challenge the way that you're thinking about volatility, whether it's choosing your strategy, whether it's looking at how much risk you're taking on a position, how much, you know, what is your position size. For me, volatility is the most important consideration there. If you have a look at the sort of holistic trading process that I have, I've put this pie chart on. I know a lot of people would disagree with the order of importance here, but when I look at the factors that I have in terms of my consideration, my subordinated chain of consideration about what's important, the most important thing for me is continuous improvement. The idea of actually looking back at your plan and over a trade and looking how you've done, and actually reviewing that and learning from your experiences. But the segments that I really want to touch on today within my sort of area of consideration, risk management, strategy, and also position size as well. There's going to be a lot of math involved. There's going to be a lot of statistics, and I'm not going to make any apologies for that. The idea here is that this is how I think about the world. I've just flown back from Outback, Australia, and I was putting these thoughts together on the plane, and it sort of just came very naturally to me, because this is my life. This is how I think about the world. This is what I do for clients, but also how I actually trade the markets myself. So it was really easy just to put this down on paper. But volatility at the epicenter, for me, volatility is the true asset class. It is the only asset class. If you think about it, if you go long the Aussie dollar, then effectively you're short volatility. If you're long equities, if you go long the S&P or the Russell, you're short volatility. If you're long oil or copper, you're short volatility. If you go long US treasuries or long the Japanese yen, Swiss franc, you're effectively short volatility. And you're looking to make a play, or sorry, other way around. If you're long the yen, then you're effectively long volatility. If you're long equities, then you're short volatility. You're making a play that this risk on, risk off vibe is going to continue. So when you're looking at equities as an asset class, fixed income as an asset class, or currencies as a sort of quasi asset class, ultimately they feed into this idea that you're making a play on where volatility is going to go, whether volatility is going to increase, in which case you're long volatility, or whether you think volatility is going to fall and there's going to be risk on coming through the markets. Effectively, volatility is that one asset class, and that's the way that I think about the world. You know, this risk on, risk off vibe, this mantra that everyone talks about. For me, really volatility is that play that you're making a speculative play on what's going to happen with volatility. Volatility is the cost to hedge. And when we're looking at things like the VIX, and whether you're looking at options and optionality, if people are expecting greater movement, which effectively is what volatility is the extent of movement from an average over a specific time frame. Most people use 20-day moving average, for example, but you can use other different time frames, and I do. The cost to hedge will go up and down depending on the expected level of volatility playing through in the market. And nowadays, if you look at a lot of the big pension funds and asset managers and fund managers, they employ these very expensive consultants to come in and offer them volatility overriding systems. And effectively what this means is they don't have to sell out of their equity holdings, their core equity holdings, their futures holdings, their currency holdings. If they feel that there's a period of drawdown coming through in market, what they'll do is effectively buy volatility structures, some very advanced ones that you and I won't even dream of being able to get our heads around. But it means that they can protect themselves in case of an extreme move in price, and it means they don't have to sell the underlying in the process and go into cash. Volatility changes the cost of trade. Generally, if you see higher volatility playing through in markets, you will see bid-offer spreads widen. If there's much lower volatility in the market, both realized and implied volatility, and I'll talk about what they actually are in a minute, the cost of trade will increase and decrease. So volatility has a major impact on liquidity dynamics, which have a big impact on the cost to trade. And for us as traders, one of the biggest headwinds for profitability is the cost to trade, spreads. It's not just what's happening in swaps and those various factors, but the cost to trade, the bid-offer spread, is a major consideration, and volatility is a major determinant of that. It affects our time in the market. If I think, and I'll show you a chart of the VIX in a minute, but for me, if you go back to that period in February to March, where we saw this 56% drawdown in the S&P in a record amount of time, we got to a point where we saw extreme volatility in the market. The VIX pushed up to 89%, which equates to around about a 5.6% daily move. And we saw markets moving on a dime. You could suddenly see the markets moving up 3%. You could see it down 2% in a heartbeat. That's not what I want to be involved with. A lot of people find that quite a nice environment to trade. For me, that I have no interest in being involved in that kind of market. And if I am, I'm not going to be trading off a daily chart. I'm not going to be certainly trading off a weekly chart, maybe not even a 4-hour chart, but I'm going to be taking my time frame right in, and I'm not going to hold positions when I can't be in front of the screen. So extreme levels of volatility for me affect your time in the market. It's a major consideration. Do I want to be in front of the screens? Can I leave the screens? If you've got volatility too high in markets, there's no way that I want to be holding positions when I can't react. You can have a stop loss on the trade, of course you can, and that protects you. But the time in the market is determined by the level of volatility that you see there. So that's a really key factor. If you're trading currencies, if you're trading fixed income, if you're trading gold, if you're trading equity markets, understanding that level of volatility playing through in markets is absolutely essential. I can understand using implied volatility. Again, there's a lot of people out there who have no idea what implied volatility is, and I'm going to explain what that is. But for me, understanding what the market is implying for movement in the market is so powerful, because I can sit there and I can understand if the market's expecting a 50 or let's say 100-point move in Aussie dollar over the coming week, and I've got a profit target if I'm looking to go into on a risk reward trade of 2-to-1, and I need to make 200 points, and the market's pricing in about 100-point movement over the coming week. Well, I know there's a pretty good chance that I'm not going to make 200 points in a week if the market's right. I might have to be in the position for a couple of weeks, and that's generally how I trade. So implied volatility gives me an understanding about how long I might have to be in the position to hit that risk reward target. It plays into my risk management. One of the main reasons why a lot of retail traders, when they come on board and they lose money, is because they don't adjust for volatility in the markets. They can have a stop loss on the trade, and they might have a stop loss below a previous low, or whatever it's going to be, a Fibonacci point, or whatever that situation is. But levels of volatility in the market for me determine how much risk I'm going to take on. And whether you're running a systematic strategy using an expert advisor, or whether you're using a discretionary strategy, the amount of distance to your stop loss needs to be determined by the volatility in the market, and we'll discuss what those are. If you're not adjusting for volatility and how much risk you're taking on, for me, that's a major consideration, and that's where a lot of people go wrong. If volatility kicks up and they continue to trade with very tight stop losses, of course, they're just going to get stopped out very, very quickly. If you run a bigger stop loss to account for the movement that's in the market, of course, then and you trade with the same position size, you're taking on the potential to lose more money. So if I see higher volatility in the market, I'm going to have a wider stop loss, and I'm going to have a smaller position size. My position size is adjusted by how much risk I'm taking on. And that's really what the common goal, and I go back to that first pie chart, which I talk about risk management, position sizing. Our job as traders is to grow the capital in our account. Let's not make any bones about anything else. That's our job. But one of our primary jobs is to manage risk, whether you're understanding how much risk to take on or upcoming risk in terms of event risk, and therefore achieving the correct position size relative to the size of your account. And volatility determines that. The extent of past movement or future movement will determine how much risk I'm going to take on, whether it's a tight stop or a further stop, and that will determine my position size accordingly to that. So this is why volatility is, to me, so important. If our primary job is to manage risk, then volatility is that key variable that we actually have to watch. Let's go back to the VIX. I use the VIX. I'm an index trader. I like to trade the US 500. I like to trade the Nikkei. I like to trade the DAX, some of these equity markets as well. And one of the great markets that you can look at, which we offer here at Pepperstone, is the volatility index of the S&P, called the VIX index. Now, for people who are not familiar with the VIX index, what the VIX index effectively does, and this is managed by the CBOE, is they get a set of options on the S&P, and they weight them effectively using options that expire between 23 and 37 days, and they blend them to get effectively an expiry of about 30 days. So what the VIX is the expected movement in the S&P over the coming 30 days. Now, that movement is priced as a number, and that number is a 1 standard deviation annualized number. As you can see, in 2019, the average volatility of the VIX averaged about 14%, which gives you an implied move over the coming 30 days of the S&P, averaging of 0.9%. And I'll show you how we can calculate that going forward in a moment. Obviously, in 2020, it was an unprecedented year. Everyone's talked about unprecedented, and you saw the VIX averaging 29.22%. Obviously, it was skewed towards that period between February and March. But that level of extreme volatility was enough to guide me and say, Chris, your strategy doesn't really work that well in periods of extreme volatility. And what I'll do is, as you can see, the blue central line is the average, and I've used this over a 5-year period. And then I've used 1 standard deviation, 2 standard deviations, 3 standard deviations. And that's what we like to measure movement in the markets by. So if you're not particularly familiar with standard deviations, effectively they are a measurement of variance or moves from an average over a set period. And those standard deviations have levels of capture, of statistical capture, and I'll talk to those in a moment. But you can see the VIX is something that I use as a guide around equity markets, and we have equity volatility measures for other markets as well, like the ASX 200, the DAX, Euro stocks. They all have their own markets. But for me, I like to use this as a guide. If volatility is too high, then it's telling me, Chris, the potential for movement, extreme movement, and extreme changes, bid offer spreads widening, does capture. And my strategy works well when in an environment where the VIX is trading around sort of 20 to 25%. So when it got up to 89%, I said to myself, I have got no interest in being involved in the equity market, not using the time frames and the strategy that I would. A lot of other people would say, this is fantastic. If I can capture a small move, I could get a huge amount of pips there. But I use the VIX, and just remember that the VIX effectively is the implied volatility in the S&P over the coming 30 days, and that gives me a guide as to expected movement. Okay, so let's break this down into realized volatility and then implied volatility. I put a spreadsheet together which I pass to clients, and I'm happy to share this with people as well. And I pulled this data out of MT4. And if you open up an account with Pepperstone as a result of this webinar, we will include the tools so that you can actually pull this data out as well, smart trader tools. So there's a number of them. I won't go into all of them right now, but the one that I like to use, Auto Chartist, and then there's XLRTD. So XLRTD is something that I can just dump onto the chart. I can drag and drop it onto the chart, and what that will do then is that will then sing with Excel, and it will be able to pull all the data from MT4, MT5 into Excel. And I've set up these series of dashboards. And one of the dashboards I have is this one called the risk management dashboard. And I set this up in a way that I can pull the data off, I can work it, I can do whatever I want with any kind of data that comes out of MT4. And one I like to use is this realized volatility measure. And if I have a look at realized volatility, effectively, this is what a lot of hedge funds will use. If realized volatility is high, it will determine how much capital they can have invested in the market at one time. You've had a lot of these, what they call risk parity funds coming up throughout the US, and a lot of volatility targeting funds who understand what a level of realized volatility is over a set period of time. And that will determine how much capital they can have in the market at any one time. If volatility is too high, or is at a higher level, then effectively what they'll do is they'll take their position size down and they'll work it accordingly. When volatility is very low, they'll be fully invested in the market, especially when they're positively trending. And that's why I like to look at realized volatility. And realized volatility is the degree of variation of daily returns, percentage returns, when you actually look at the change in price over a set period of time. Now, I like to use 20 days. So effectively what I'm getting is 20 days worth of data. I'm looking at the net change in percentage terms on the day. We're getting the mean, or the average of that time, and we're looking at those daily changes, and we're effectively looking at the variance of those. And that will give me a daily variance level. It's quite statistically minded, and I apologize for that. But for people who want to understand this is a different type of volatility from what a lot of people will have used before. But what it does is it looks at the daily changes up or down. Volatility is directionally agnostic. It doesn't determine, it doesn't discriminate if it goes. Volatility can be up and down. I know everyone thinks it's synonymous with down, down moves. High volatility means we're seeing down moves in equity prices, and people going into the yen and the Swiss franc and all those kind of characteristics. But the realized volatility of a market effectively is the average of a price, the average movement over a set period of time, and the degree of price changes that come through that. Now, in statistics, we use this probability density chart, which you can see on the left-hand side. And this is where it becomes really powerful. You can see the average in the middle, and this is a normal distribution. So effectively, there's no real skew in the market. And we're not accounting for any kind of positive trending markets. This is usually a sort of a neutral to bullish market, slightly bullish market. But you can see here that if we have a set of outcomes, a set of price moves, generally speaking, in statistics, in a normal distribution, that the various price moves, 68.2% of those price moves will be contained within one standard deviation. So the bulk of them, nearly 70% of price outcomes will be contained near the average, the mean, to one standard deviation. So that's why it's quite powerful for me. The idea that we have a quantifiable level by which we need to see price moves. A lot of people will use Bollinger Bands, and Bollinger Bands effectively using traditionally a 20-day moving average. And if I bring up my MT4 chart, and let's go to Aussie Yen, for example, or Dollar Yen. See, what we can do is we can determine our period, which most people use the 20-day. I think in Dollar Yen, sometimes quite a lot of the time I'll use 50-day period moving average, and I'll take that deviation down to 3 to capture more. But what you can see here in the green is the 20-day moving average, and you can see 2 standard deviations either side of that. Now, why do people use that? Why do people use Bollinger Bands? Well, let's go back to that chart there, because Bollinger Bands not cap 2 standard deviations either side of that 20-day average. As you can see, 2 standard deviations capture 95.4% of price moves. So when people use the Bollinger Bands, you can see that they're mean reverting. They'll say that price has moved outside of the Bollinger Band, and statistically speaking, it shouldn't really go much further unless there's a big change in the actual market. That's why a lot of people will look to fade using Bollinger Bands, because statistically, you know that those price moves are going to capture 95.4% of those points. With realized volatility in the 20 days, it captures 68.2, so slightly less. But that's really what I'm looking for. And what we can do is we can go to Excel. Oh, I can't get it now. And I can, as you can see here, I can pull out 20 days worth of prices on the Aussie dollar, which again I'm pulling out from my Excel from MT4 using that Excel RTD. Look at the price change in percentage terms, and I just use this standard deviation number here, and that tells me the daily price changes. So using Excel, I've managed to calculate the daily variance from the mean. So on a 20-day period, Aussie dollar is up or down 0.6% in those 20 days. The average or the variance from the average is 0.6%. So I can now use that, and I can say that with a 70% or 68.7% level of confidence, that price moves in the Aussie dollar over the last 20 days were about 0.6%. So that's quite powerful, that the actual performance and the percentage moves over those 20 days are 0.6%. Again, I put that onto the spreadsheet there, and you can see there, if I actually put that Aussie dollar move and I fill into that form, you can see that the 20-day realized volatility, when we annualize that, is 9.3%. I look at that in context of where it's been over the last 2 years, and you can see it's trading around the 20th percentile. But what we can also do is then work out what that move is, 0.6%, on a daily basis relative to the price, and you can see that equates to 45 pips up or down. I can then project that level of movement relative to where the market's trading at the moment. So if the annualized volatility is 9.3%, based on what we saw from that daily variance, we can project the expected or the move that's happened over the coming period ahead of us, which you can see there. So that might be a lot to take in for a lot of people, but realized volatility is what a lot of professional traders use to understand the extent of movement that's happened. Again, this is something that we put on the spreadsheet, which we can send to you. Auto Chartist is another one that we have on the MT4 system. And Auto Chartist is an external company who come in, and we've created this as a smart trader tool, which you can see there. Let me bring up an Auto Chartist one. And what Auto Chartist does is projects, is a similar sort of concept. It uses the last 6 months worth of data at that time for a currency at a certain point in time, and gets the average for that period of time. So let's say on the close on Friday, on Saturday at 9 a.m., it will get the price of cable, and we'll get the closing price for the last 6 months, and then it will give you one standard deviation, again capturing 68.2% of those moves, and it will project that onto the chart. As you can see here, the market closed at this level here, but what it's doing is it's saying for Monday, using 6 months worth of data from that one point on Friday, on the Saturday morning close for us here in Asia, if we project and get one standard deviation, which captures 68.2% of the potential variables, we will project a move of 136.54 to 134.67. The great thing about Auto Chartist as well is when you actually have an account, you can go to their website, which they'll give you a specific link, and it'll give you, using that same concept, the expected move using statistical fact over a specific period. So you can see here 15 minutes. This is at 9 a.m. So it takes that snapshot, and it's saying we're going to project over the next 15 minutes that the price is going to change, chop around. This is going to be for Monday, between 135.67 and 135.54. And then it takes the 30-minute candle, the 1 hour candle, the 4 hour candle, and then the daily candle, which is what I showed you on the chart just a minute ago. And it gives you this projected move based on statistical volatility. What also it does, and you can use this for any currency or any of the products they have, is that it looks at statistical movement in the hours of the day. You can see here at midnight that they're basically saying that the average over the last 6 months at midnight, and this is set by my time here in Australia, is around about 32 pips. So the average movement per day at that time is 32 pips, and that's with that's the average level. But they're saying with a 68.2% level of confidence that it will trade between 40 pips and about 26 pips there as well. And that's really important for me because I'm trying to understand what time of day is the most volatile in a currency pair. You can see this in dollar Swiss, for example. The widest part of the day is at 2 o'clock in the morning. Now, why is that probably likely? It's because it's over US trading session. A lot of data is released, and then you're going to see those big moves playing through. You can also see the potential movement or the statistical movement by day of week. And again, that's really important. If you're trying to understand what session you want to trade in, what day of the week you want to trade potentially, you can understand some of the characteristics about movement that's playing through in the market. Again, very important. So that's Auto Chartist. And that's something that if you were to get the MT4 platform, you can get that as well. So not only does it project levels based on that price and using that as a mean, and then projecting levels with a 68.2% level of variance. Bollinger Bands, which we've covered. As I say, I tend to like Bollinger Bands as mean reverting tools. The way that I like to look at Bollinger Bands as a mean reverting tool is I like to look at when we're seeing sideways trending markets. If I go to my spreadsheet here, what I've done is I've set up a momentum and trend scanner effectively. And what I've asked the system to do is pull out where the 5-day exponential moving average on a lot of assets are, where the 20-day simple moving average is. And I want to understand if price is above both the 5 and 20-day moving average. Is it above or below the central pivot point, and where the RSI is? So that will give me a good understanding for mean reversion. And what I want to look at is markets that have conflict. I really want to see the RSI at 50 because that's right in the middle, and that tells me that the price is not trending in any kind of particular direction. If we take, where's one where at 50? We take cable, for example, you can see that we're talking around 55, RSI is at 55 at the moment. So that's right mid-range. And you can also see that we've got conflict here. Price is neither above or below both the 5-day and the 20-day simple moving average, and it's below the pivot point as well. So you've got a bit of disagreement amongst that. So that to me is a perfect environment for using Bollinger Bands as a mean reverting tool. So I'd like to use this scanner just to give me a sense. As you can see here, when I come in, I can see that all the equity markets at the moment are really bullish and pushing, the RSIs are pushing higher. So I can come in the morning and I can see, if I go to the to the Nikkei, for example, that is an absolute beautiful setup at the moment. You've got price above the 5-day simple moving average or exponential moving average. Price is being contained into pullbacks. It's breaking out. Look at the power behind the breakout. And again, that's something that I'm not going to be looking at Bollinger Bands and using them as a mean reverting tool. But what you can do is you can use them with cable, for example, where I saw disagreement between those two variables and the RSIs at 50. If I bring up If I bring up cable, for example, I put a Bollinger Band on there. Well, you can see that it's not quite in that environment where I want to be seeing. What I love to see is the 20-day moving average moving perfectly sideways, the Bollinger Band starting to contract, which showing that the actual extent of movement from that 20-day moving average is becoming less pronounced. And that's what Bollinger Bands are doing. Effectively, if they're widening, it's telling you that the movement, price movements, are deviating much more greatly against that 20-day moving average. When Bollinger Bands are coming in, it's telling you the extent of those price movements are coming in relative to the mean as well, and it's showing you that there's lower volatility. But again, it's a statistical fact that we've been seeing. Pivot points, not really volatility as such. It's the extent of price movements. I like to use pivot points as well. I love to use pivot points, but not as much as I like to use implied volatility and realized volatility as well. But what I like to do is put pivot points on my charts when I'm looking at levels within the day where I can actually see extent of movements, and also linear regression as well. I like to use this from a statistical point of view. If we go back to the MT4 chart, let's go back to dollar yen. Just going to get rid of this Bollinger Band. Okay, so you can see if we go to not that one. So if I draw a standard deviation, okay, so what we've done with this using as a statistical deviation is we've drawn a line of best fit through this move in dollar yen. We've seen this obviously making lower lows and lower highs and higher lows and lower lows, and it's trending lower. And you can see that I can get a 5-day moving average or a 20-day moving average. Let's change this to a 20-day moving average. And you can see quite clearly that when we've blended this down, this is trending lower. And what I like to use is this line of best fits, and we've drawn a channel, but this is a statistical channel, similar to a Bollinger Band. Effectively, where a Bollinger Band will use a moving average, we've used the line of best fit here. And this will tell you with one standard deviation, again, capturing 68.2% of those price movements, of those moves, that we should be contained within this level here. So if there's any kind of decent rallies that play out in dollar yen, I'm looking to fade them into the top of this move here. We've got a statistical level of confidence that that's going to play out and people are going to look to sell. Again, you know, if there was to be a significant move down in dollar yen, maybe there's some risk off environment, or there's something that's caused the dollar to weaken so substantially. You can see now that we can come down into this lower bounds of this statistical channel. And again, that's a form of volatility as well. So these are really the measures of volatility that I use. I know there's other things like envelopes and Keltner bands and those kind of factors as well. But I like to look at realized volatility, the extent of movement, percentage movement from a mean over a period of time. Then what we can do is, when we actually understand the degree of movement, is we can actually find out what the annualized level of that, and volatility is the square root of time. So if we know there's 252 trading days in a year, to get an annualized number, we just put that in Excel as just this SQRT 250 times that level of variance, and that gives us an annualized number, which is what the VIX is.
Hey, Chris.
Hello.
Hey, just want to give you a slight nudge to say that we have about 10 minutes left.
Okay, perfect. Okay.
All right, thank you.
Cool. When it comes to that realized volatility and an annualized number, what I like to understand is where that actually sits in the context of time. If I've annualized that daily movement to 6 point, say with euro dollar, it's at 6.3% at the moment. Now that doesn't mean a lot to a lot of people. It's basically saying that euro dollar can move up or down 6.3% in a year. And that's what it's implying. That's what the statistical fact is saying. But I like to chart this, and this is what we put out to clients as well. So we're looking at the annualized statistical returns that have happened. And at the moment, on the current degree of movement that we're seeing in 20 days, it's saying that the euro dollar is moving up or down 6.3%. And again, I'm trying to put this into context, and you can see the blue line here is the average, and you can see 1 and 2, 3 standard deviations through that. So it gives me an idea about the extent of the movement. At the moment, realized volatility in euro dollar is pretty low when we put it into context there as well. We have a look at Bitcoin. Now, Bitcoin's an interesting one because we can't really look at implied volatility. We can look at statistical volatility in Bitcoin, but it's been absolutely huge. Like if I look at the high-low range in Bitcoin at the moment and divide that by the prior close, and that will give me the extent of the range that we've been seeing in percentage terms. You can see on Friday it was 13.4%. So a 13.4% range in Bitcoin. Now, what does that mean for me as a trader? One, if I'm going to be involved in Bitcoin and using CFDs or whatever kind of mechanism to be involved in Bitcoin, my position size needs to be super low, because you're having a 13 percentage point range on any given day. You can see in July it got down much lower, down to sort of 1 or 2%. And in March, we actually got up towards 35%. If you go to Ethereum and some of the other coins, you can see that the intraday ranges are substantial. Again, that comes down to the idea that my volatility, my position size has to be super small in that context. If you actually look at how that works in terms of realized volatility, we're getting the 10 days worth of data, 10 days worth of prices. We're looking at the price change. We're getting an average, and we're looking at the degree of those price changes relative to the mean. And you can see there that on an annualized basis, Bitcoin's 10 days realized volatility has got to 95%. Now, if I divide that by 15.9%, what does that work out to be? 5.7%. So the average move, what the realized volatility is saying, that the realized move at the moment is about 5.7% in Bitcoin. If you don't have the risk tolerance to be able to do that and adjust your position size accordingly, you're going to get hurt. You're going to get blown out very, very quickly if you get the position wrong. So again, Bitcoin for me and some of the cryptocurrencies is absolutely critical. And you can see the similarities between those high-low ranges and the 10-day realized volatility there. They're very, very similar indeed. Okay, so what else do I put on my spreadsheet, which we send out to clients? And what's more important, and I realize that I could probably go on for 2 hours, so a lot of people are probably scratching their heads going, this is all a bit crazy. But what I want to do is I wanted to scratch the surface for you guys and show you what professional traders use for their trading and how they can manage risk and understand manage risk. And we can offer this to you if you open an account, as I say, with Pepperstone, and you can get these get this level for your trading. Now, implied volatility is derived from options pricing. Again, it's an annualized number, and it talks about the degree of movement that is expected from the market over a specific time, up or down. If you see implied volatility at 15%, it's implying that euro dollar is expected to move up or down 15% over that period of time, using options prices to determine that. The higher the level of volatility would be determined by the demand for those options. The demand for options is determined by whether people see the options going in the money. The higher the demand, the higher the expected movement that's going to go through there. So I use implied volatility for my trading, and we put it out to clients in as part of the spreadsheet as well. Now, what that means, that tells me is the market is looking forward. It will take a degree of realized and statistical volatility in, but what it will do is it will look forward. It will look forward at event risk that's coming up, whether it's a central bank meeting, an election, or non-farm payrolls, and it will tell you what it thinks. It tells you, do people think this is going to be a volatility event? When you put context on that, and okay, this is the Australian dollar implied volatility at the moment, which you can see is 10.3%. That is telling me that the market is saying, using 1 week options, that if you annualize that, using 1 week options, that the Aussie dollar is expected to move up or down 10.3%. Now, it's obviously significantly lower than where we were in March, where the market was about 37%. They're saying Aussie dollar could have a move of 37% on an annualized basis. It's come down a little bit. But what we do is this offers context about what people see as movement. Now, the really important thing about that is, instead of me taking a judgment call this coming week about what is likely to be to spur movement, it tells me what the market thinks. It tells me, do the market expect higher volatility, greater degrees of movement in the Australian dollar or the euro or gold or the S&P or whatever it's going to be. At the moment, you can see it's around the average, which is that blue line of the 2 year. I've got the 2 year prices there, but this is the average. So that's a really important statistic there. We can see that it's not actually that high, but I can actually work out from that implied volatility the extent of the movement over the coming week. If you have a look at the volatility chart that we put out to clients, and I'm going to do another specific webinar about this coming up on the 28th, and actually use this to trade off. So if you want clarity around this, as I say, we're coming up to time. I haven't had a really great chance to go through the charts and look at projections here. But what we can see is that the implied volatility using weekly options for the Aussie dollar is 10.3%. Now, the square root of 252, which is the amount of trading days in a year, is 15.9. So we can use any annualized number, such as the VIX or what you see here, 10.3%, and divide that by 15.9%, and effectively get the extent of movement that's projected by options prices. As you can see here, 10.3%, when you divide that by 15.9%, and you get the current spot price, which is 77.57, that gives you a move up or down of 111 points over the coming week. That gives me an expected movement in Aussie dollar of 78.68 down to 76.46. Now, why is that important for me? Not only does it tell me whether the market's expecting big movement relative to where we've been and whether there's going to be greater volatility or less volatility, but with a 68.2% level of confidence, it's telling me that they're projecting 111 points. So I can use that as in my risk management assessment. I will have a stop loss 111 points, at least 111 points away when I'm going through into my longer term charting, when I'm using daily charts, when I'm using 4-hour charts, and I'm using weekly charts for oversight as part of my sort of macro framework. I know that I have to have a stop loss at least 111 points away. Now, that's obviously doesn't really help people who are scalping the market or people who are looking at really short-term positions. But the way that I personally trade and I'm holding positions, I know that I have to have a stop loss 111 points away. And I can tell that because if I'm going long the Aussie dollar, I want to have my stop loss at least 76.46. If I take that down to 2 standard deviations, which captures 95%, I can go in, I can have a stop loss. And I can say, well, with a 95% degree of certainty, the market is telling me that the price should not move down past these levels. And that protects me against the tail risk event. So what the great thing about options does, and what we offer to clients, is the extent of expected movement over the coming week in these different assets. You can see gold here. The market's expected, the implied volatility is 18.8%. Using weekly options on gold, the market's expecting an 18% move up or down over the coming year using weekly options. If you break that down into daily numbers, you can see that the expected movement on a weekly basis is $47. As again, you can see the implied move with a 68.2% level of confidence is 18.95 to 18.02. So I might take a long position in gold at 18.49, which is where the price is at the moment, and I'm going to have a stop loss at 18.02, and which is $47 away. And I know that the market's given me an implied probability that there's about 70% chance the price is not going to move through that point. Again, very, very powerful. On the webinar that we're going to be doing on the 28th, I'm actually going to go through the whole process of using not just the implied levels that are coming through, but also the auto chartist daily numbers. We can use ATRs, average true range, and we can use other factors as well to understand and actually place trades. The other thing that I like to use on a daily basis, and then I'll just wrap up here, is using overnight options. And we use overnight implied volatility. And the great thing about this is it looks ahead over the coming 24 hours and it tells you the expected movement, which really complements what we see on the auto chartist note as well. So again, let's take euro dollar, for example. We can see that the overnight implied volatility is 4.1%. So using overnight one-day options, they're saying there's about a 4.1% move in euro dollar over the coming year. Now, what does that equate to? If we divide that by 15.9% and we actually work out that number is relative to the current price, it gives me an implied move of 32 points or 32 pips up or down with a 68.2% level of confidence over the coming 24 hours. So that gives me a level of 122.50 to 122.86 with a 70% level of confidence, or I can take that to 95% level of confidence. And I know that euro dollar is unlikely to move lower than 121.54 or higher than 122.82. I have a level of confidence that comes with that. And again, these are the levels, rather than actually taking my long-term positioning trades, which I talked about in the last slide, these are levels which I'm going to be trading on the 28th, which we're looking for mean reversion. These are considered extreme moves, and you can use these really well with pivot points and also things like ATR and also the auto chartist as well to get quantifiable levels where the market is implying that these are extremities playing through, which is where we're going to leave stop order or limit orders either side of the market again. So what the great thing about this is it tells me the degree of movement that's expected by the market. And we're going to place trades around that as well. So just to wrap up, I know there's sort of rushed through a lot of what we've been seeing, but volatility is a huge, huge subject. When you scratch and you look down the rabbit warren, it will change the way that you think about markets, whether you're looking at realized or statistical volatility and using that to understand how much risk you're taking on and your position size accordingly, or using the report that we offer, which looks at implied volatility and the levels of expected movement coming through. And you're adapting that to understand over a week basis or a day basis, just the expected movement. Again, that can be very powerful for mean reversion trading as well. So these are the strategies that I employ and push out to clients as well. So volatility determines your strategy, it determines your risk. And I want to encourage you all to really think about how you use it in your trading.
All right, perfect. Thank you, Chris. And here I have Alex joining me as well. Alex and Chris, maybe you guys can talk a little bit about the webinar on the 28th. Alex, I think you've shared a link.
So Stone is our sponsor, and they are very kind enough to offer these two that Chris has mentioned just now in the MT4, MT5. So as long as you open an account with them, be a demo account or a live account, you do need to fund it, okay? You are still able to get the Smart Trader tool for MT4 or MT5. So just in the application form, just the Here of Us section, all right, you just key in marketwise Asia so that they know that you are from marketwise Asia and they will give you access to the tools for free, okay? I repeat, so you do not have to fund the account straight away. You can just open a demo account or even a live account, right? You are able to get all these Smart Trader tools for free. And also, Chris has a additional follow-up volatility webinar coming up soon, right? So I will post the link in the chat box so that you guys can see and register for the link. So you guys should be able to see the link at the right-hand side of your screen and also on the chat box. All right. So the volatility webinar. Can I share with Chris when is the date for the follow-up webinar?
Yeah, so it'll be on the 28th of January. 28th. So yeah, you can. Yeah, get in touch. There's the details there either through Twitter, get in touch with my email, or through Susan Fu, who runs our Asia Pacific desk. And really she's a relationship manager there as well. And really the objective there is I've talked a little bit about the implied volatility. We'll go into a bit more depth around that spreadsheet, and we'll happily send out a copy of that spreadsheet for your trading, which will sing with that XLRTD function, that Smart Trader tool, which you can dump on and you'll be able to communicate and be able to program and do whatever you want on the Excel. But then what we will be doing is using that implied volatility to look at levels on the day, and then complementing that with the auto chartist function and pivot points to give us quantifiable levels with degrees of confidence about where we're going to trade on that period of time, and look for mean reversion trades. So we'll do some live trade. We'll go into a bit more depth about what it all means and actually play some live trades and show you how it works in practice there.
Okay, so DG is asking whether there's a referral code for this. So when you sign up for the account, you should see this here from us section. So just key in the MarketWise Asia and you'll be able to get all these tools for free. Okay, so thank you, Chris, for your sharing. The next session is at 12:30. And yeah, let me post the next room link for you. Okay, so give me just 30 seconds. Okay, let me just post it up. All right, you should be able to see the link is by Caden Chang. He will share with you how you can be the most professional fund manager regardless of market direction. And you should be able to see the link in the chat box also. All right, so thank you, Chris, for your sharing. And remember to click on the open account with Pepperstone and you'll be able to get these tools for free. Okay, so see you guys in the next room at 12:30. And thank you, Chris, for sharing. And I will end this webinar now. Thank you, Chris.
Thank you.
Thank you.
Thank you very much.
Bye-bye.